Let's talk about barbecue advice. As a business owner, you've definitely heard it before. You've gone to the family barbecue, you've gone and caught up with some friends, and there's a so-called guru that's professing to know a particular strategy. They've got a stock recommendation, a particularly property strategy, a new crypto coin that they're confidently spruiking. I say this all of the time, guys, and I wanted to give you some insights to help you navigate bad barbecue advice, because I very rarely see this go well. It's definitely a game of chance, and we want to make sure that when we're implementing an investment strategy as a business owner, that we can be systematic, we can be objective, we can be rules-based to ensure that we can grow our wealth confidently into the future. Now, this was inspired by a post I did recently talking about BlackRock owning the world, buying all of the major companies in the world, buying all of the real estate. And as I thought, there was an individual who jumped onto that post and said, BlackRock owns all of the companies and they own all of the Australian real estate. And I'm like, show me some proof. And he's like, oh, I don't have any proof. I can't show you proof. But my friend told me that this is true. Well, firstly, your friend's a fucking idiot. When it comes to anything financial, unless you've got it from a reputable source, it's probably not true. And we see these kind of rumours get pushed around because, quite frankly, they're exciting. They're a lot of goss, but they lack substance. And they're typically a fraction of idea, a fragment of an idea that has been blown completely out of context and completely out of proportion. And it's actually very costly. So let's go through this. The common barbecue advice that I see is something macro that ultimately keeps people sitting on the fence. For example, the property market's going to collapse. Don't buy property. The market's going to fall and we're going to be able to buy it on sale. The share market is going to collapse. We're overdue for another GFC style event, and there's going to be blood in the streets, and you'll be able to buy amazing companies at cents on the dollar. And all of these similar conversations that exist. Now, for the vast majority of these individuals who are driven by fear and the idea of getting the perfect timing in order to get all of their money into the market and capitalize on that timing, they're few and far between. And more often than not, these individuals end up losing hundreds of thousands, in some cases, millions of dollars in lost opportunity as a result of sitting on the fence. Because what ultimately happens is that loss aversion bias kicks in. These individuals keep their money in cash, particularly even if the markets do fall. They never get the timing right because they wait for the market to start bouncing, and they end up missing a lot of the opportunity they were waiting for in the first place. Because obviously when you're seeing the market correct, unless you've got the opportunity to capitalize and get that timing perfectly right, you're never going to know at that particular point in time. You need the benefit of hindsight to know that the market hit its bottom and then sharply recovered. And even professional investors very rarely get this right. So the next situation is speculative asset selection. So usually how this goes is like, oh, I got this secret tip from somebody who's in the know and they understand exactly what's going to happen, and this particular stock or this particular property market is going to go gangbusters. And most of this is, once again, pure speculation. None of it is based on the intrinsic value. Nothing's based on fundamental data points of what that asset is particularly worth. And it's very much throwing a dart at a dartboard. Now, we've seen this happen in particularly associated with situations whereby, say, an Olympics or a Commonwealth Games is announced, or a particular infrastructure project is in negotiations, or a particular stock, let's say it's a biomedical company that the new cancer-curing drug is just about to get approved for human trials. And there's always some sort of speculative situation that is basically underpinned by a single speculative decision, which very much lacks intrinsic value, and it's about as good as throwing darts at a dartboard or going to the roulette table and putting all of your money on red. The reality is the odds are probably worse. So the problem with this kind of philosophy, guys, is that, once again, it relies on chance, and chance is not a predictable way to build wealth. True wealth is built on an operating system. It's an operating system of understanding what you're actually trying to achieve. So let's say, for example, you want to get to a point where you've got $200,000 a year in passive income. Back of the envelope calculation, you need about $5 million in net wealth. Then we work out, okay, well, by when do we want to get there? And do we want to use capital growth to get there? And then we're going to shift to income. Do we ideally want to build up the income producing assets now? And obviously, because we're not necessarily getting as much capital growth, is it going to take us a little bit longer? But we can do it in a more pure sense of producing that passive income along the way. That then allows us to design an asset allocation. What types of assets are we going to acquire that allow us to contribute those kinds of characteristics to your portfolio to allow you to achieve those goals? We then define your risk tolerance, understanding what is the likelihood of risk versus return. In other words, what is the standard deviation or the potential for volatility compared to our expected risk premium that we're going to get from those various assets. And then what does our cash flow permit us to do? And of course, our borrowing capacity if we're looking to use leverage to accelerate our path to achieving those goals. We've developed a philosophy that's called the investment operating system, and it's fundamentally 9 checkpoints that go into making objective and forward-facing investment decisions to ensure that we don't lead ourselves astray and make silly decisions that cost us a lot in the long term. The benefit of this, guys, is when we've got financial operating rules, when we've got a plan, when we've got an investment operating system, we're still going to be presented with these kinds of opportunities, and it allows us to have a filter whereby we can filter these particular decisions by the system, and it's either going to pass or it's going to fail. We can be objective, we don't necessarily need to get emotional, and we can ensure that we're making good quality decisions as we work towards financial freedom. My philosophy is taking the least amount of risk necessary to get to the goal, as opposed to the other way around. This is particularly important for business owners to consider because we are risk takers by definition, but we don't necessarily need to risk the house when we're building wealth. Let me know your thoughts.